Hey, what's up, guys? So I appreciate you coming through. First off, this is not financial advice. I'm not responsible for any wins or losses that you make in markets, as they are super volatile, super risky, and I am not a licensed financial advisor. I'm just sharing these ideas with you for educational purposes only. So now that we got that done, let's go ahead and get to it. Hey, what's up, guys? So I appreciate you coming through and checking this video out. What we're going to be going over today is how to trade news. This works in any market, whether it's Forex, crypto, stocks, bonds, anything that you're looking to trade. If you're looking to see a reaction based off of news, that's what we're going to go over. Many of you probably looked this video up trying to learn how to predict the market and look at, okay, well, we have inflation or we have interest rates, and you're trying to use, the expected numbers, and you're going to try to predict the market and pretty much see the future. So that is what I'm not going to teach you. What I am going to teach you is how to react. And all you need is a chart. You don't need to know the news. You don't need to know the numbers. You don't need to know any of that. As professional traders, we do not entertain the idea or the notion that news is going to assist us in any way. A lot of times, smart money capitalizes off of news to engineer retail liquidity. For instance, we have bearish news, price makes a move to the downside with a quick reversal to the upside and traps a lot of traders or liquidates them. That's what we see here in this example. We don't try to predict the future. What we try to do is react to what price action is telling us. So in this example, we have, this is on June 30th, this was 2022, and this is the S&P 500. We had very high impact news early in the morning at 8:30 a.m. This news was perceived to be bearish. As you can see, we had a big move to the downside. What was happening here was a lot of longs that were obtained in this range right here, they were stopped out. And then what did everyone want to go do? Everyone either shorted the breakout or wanted to sell here. Whether they were selling at their stop losses or they may have been looking to sell short here. We obviously see that that did not work, and this was a form of inducement or tricking the uninformed retail traders into becoming liquidity for smart money in order to further their agenda. So, three main steps to this model, and this can be used for buys or sells. Step one, you want to see liquidity taken. Now, in this example, we have the sell side being rated. It can be the buy side, for a sell model. But we want to see the early traders stopped out of the market and the breakout traders are induced into the market. This creates a lot of liquidity that smart money is going to use to further price in their direction. Oftentimes, it is the opposite of the first move. The way we're going to confirm this is we're going to look into the lower time frames and we're going to see, what is price doing under these old lows or above these old highs. Because these are liquidity pools, we want to see if price is going to absorb that liquidity and then move to the other side and take out the other side. So once we get a market structure break under our old low or above our old high, we want to make sure we see that in an animated manner. We want to see a big push, not a little tick. We want to see a big move that we can clearly see this by using fair value gaps or imbalances, IPAs, whatever your favorite guru has rebranded them as. We want to see a fair value gap. So upon price returning to this fair value gap, that's where you execute. This is not based off of supply and demand, but it can be paired with supply or demand zones for extra confluence. Once you are in the trade, you put your stop loss under the lowest low, and then you target the opposing liquidity. So in this example, we rated the sell side, all the sell stops or the short sellers we're getting in the market here. So after the sell side is offered, then the buy side is going to be offered. So you can notice that this was all planned out, right? They'd formed these equal highs, giving retail the false perception that this was resistance and that price would not go above here. So what was in this area? Buy stops or people looking to close their shorts. Anyone who's short in this range, their stop loss was most likely right here or up here, these equal highs. So you look for those opposing liquidity pools, and you look for that to be taken after you get this model. So let's look at this on a chart. That way we can actually see, what happened. So coming to the market in the morning, you sitting at your desk before equity open. Now I'm going to go ahead and mark some lines just to give you a view of the times. Now, what's very important is that we don't try to play this model before equities open. Now, you can find liquidity raids and find scalping models. We're not here to talk about that. We're here to talk about the raids that usually, not always, but usually are in correlation with news. And they happen every day. And there's not high impact news every day, but you'll really see this happen when we have high impact news. So what we're going to do when we come to our desk, you're hopefully at your desk a little bit before equities open, and you're going to go ahead and see where is the obvious areas of liquidity. Where is the very clear areas. You're going to mark both sides. So yeah, let's rewind this a little bit. We all know what happens. This is in hindsight. Now, let's see. We have a ton of liquidity resting under here. So we can go ahead and annotate our charts in the morning, get a visual of what we're looking for. Now, what we're looking for specifically is one of these sides. We want a very violent push, right? We don't want to tick above it. We want a push where it is undeniable that smart money or a larger investor, sponsored this movement. Usually this happens between 9:30 a.m. Eastern time, that's New York time, and 11. We don't want to take this trade if it occurs past noon. So this is your window right here. So we see that big move. Notice how we have a very significant push to the downside. Now we've rated this liquidity. So what I like to do is I put as a little arrow to show where the sweep was. It wants to be backwards. Let's go ahead and move that. But once we have identified that we've swept one side of liquidity, what does everyone want to do here? All the retail breakout traders are going short. Even supply and demand traders are getting faked out here because they might see this as a form of flip supply or something along that notion. But what we look for is a break in market structure. So let me go ahead and we'll mark this all up. So what we're looking for here is a correlation between the price and news. Now, notice, if maybe there is some guy out there who said, I shorted at the top, I knew that the news was going to be bearish, whatever, right? You're a gambler. But if we want to capitalize this in a professional manner, we're looking for the impulse swing that's going to tell us, the market's going to give us insight on what is happening here. So specifically what we're looking for is this liquidity rate. So that's the first step. That's where you have an idea. You don't execute, you don't just buy under here because this can continue. I'm not saying that every time you see a liquidity rate, it's going to reverse. What we use to determine if we want to enter a trade is our break in market structure, right? So that's the second step in framing this idea. Once we get a break in market structure, we want to make sure we have displacement. Now you can use the 1 minute, the 2 minute, the 3 minute, lower time frames than a 5 minute to identify these breaks or these fair value gaps. So once price pushes down into the fair value gap, this would be your entry. You're looking to go long here. Now, you can use the most recent low as a stop. I encourage to use a wider stop loss if allowed. It's up to you. That's on your risk profile. So we can see that we had a very quick and dynamic move back to the opposing side of liquidity. Very easy to spot once you are versed in this. Usually the setups are pretty explosive. You get a pretty satisfying move with this kind of trade if you do it correctly. Now it's not always going to be like this. it can mosey around a little bit and then take off. But the important thing is that you just have a mechanical requirement or a mechanical criteria of what you need to execute, because it's always going to be kind of scary in this setup, because you're under those old lows. You don't know if the market's going to continue in its direction. But that's all. If you guys have any questions, feel free to ask them in the comments. If this helped you, I'd really appreciate it if you could like, comment, and subscribe. It helps the channel grow immensely. Until the next video or my daily live streams that I do every day, Monday through Friday, I will see you later.